Bismillahirrahmanirrahim. This is the second video on a further look at financial statements. In this video, we will solve exercises on classified balance sheet. We will classify accounts on the balance sheet. We will explain how to prepare the current assets section of a balance sheet. We will classify financial statement items by balance sheet classification. We will classify items as current or non-current assets and prepare the asset section of the balance sheet. We will solve exercises on ratio analysis. We will compute and interpret profitability ratios. We will compute liquidity ratios and compare results discussing their findings. And finally, we will compute and interpret solvency ratios. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us look into the first exercise. Hoffman recently received the following information and we have to prepare the assets section of Hoffman. So we start with cash and cash is 800. Then we have accounts receivable 1100. Then we have inventory 3400. Then we have prepaid insurance 2300. And the total of these current assets is 7600. To this, we are going to add the equipment of 10,700 and we will subtract the accumulated depreciation of 2,700, that makes 8,000 and the total will be 15,600. Let us move on to the next exercise. Heather Corporation has collected the following and this is the similar one as we have done before. We have to prepare the asset section of Heather Corporation. Once again, we start with the liquidity status of each account. So we start with cash, that is the most liquid asset, 13,000. Then we have accounts receivable 22,000. We have inventory 58,000. Then we have supplies 7,000 and the total is 100,000. To this we add equipment 180,000 and we subtract the accumulated depreciation of 50,000, that makes 130 and the total is 230,000. Okay, let us move on to the next exercise. The following information in thousands of dollars is available for H.H. Haynes and we have to prepare the asset section of a classified balance sheet. We are slowly progressing and you can see in the previous we have only two types of accounts, two groups of assets, but now we are going to have more than two. We have current assets, we have the long-term assets, intangible and other non-current assets as well. So let us start with before we go further, I would like to hide this other current assets as . Okay, so we start with again with the liquidity. We have cash and cash equivalent, that is 373 145. Then we have accounts receivable 1,171,797. Then we have inventories 1,237,613. Then we have prepaid in expenses of or insurance of 1,125,765, and the total is 2,908 2,908,320. Then we have land 76,193. Then we have building, and building is 4,033,369. Then we have, from this we will subtract the accumulated depreciation of 2,131,260. That makes 1,902,109, and the total of these assets will be 1,978,302. To this we will be adding the intangible assets, 3,982,954. And finally we have other non-current assets of 757,907. So we have recorded all these accounts, and the total will be 9,627,483. Okay, let us move on to the next exercise. The following financial statements were taken from the financial statement of Kalyan Corp. Match each of the items to its proper balance sheet classification. If the items do not appear on a balance sheet, we have to simply write down an A, not applicable. So salaries and wages payable is a current liability. You can see we have to use these abbreviations. Service revenue is obviously not applicable because this is for the income statement, not for the balance sheet. Interest payable is a current liability. Goodwill is an intangible asset. Current short-term investments is a current asset. Mortgage payable is long-term liability. Investment in equipment is long-term investment. Accumulated depreciation, or rather I should put equipment is property, plant and equipment. Accumulated depreciation is also for property, plant and equipment, but definitely this is going to be subtracted. Depreciation expense is not applicable. This is for the income statement. Retained earning is stockholders' equity, and unearned service revenue is again a liability, and this will be unearned revenue, service revenue is a current liability, and then investment in real estate is investment in real estate is long-term investment. Okay, let us move on to the next exercise. The following are the major balance sheet classifications and match the following accounts to its proper balance. So accounts payable is obviously a current liability, accounts receivable is a current asset, accumulated depreciation is property, plant and equipment, building is property, plant and equipment, cash is a current asset, goodwill is a intangible asset, income tax payable is a current liability. Investment in long-term bonds is the long-term investment. Land is property, plant and equipment. Inventory is current asset. Patent is intangible asset, and supplies is a current asset. Let us move on to the next exercise. The following financial statements were taken and we have to match each of the financial statement items to its proper balance sheet. If it does not appear on a balance sheet, we have to use an A. So trademark is a intangible asset. Notes payable, you can see it is current, so this is a current liability. Interest revenue, this is not applicable, this is not a balance sheet item. Income taxes payable is current liability. Debt investment is a long-term investment. Unearned consulting fees is a current liability. Inventory is current asset. Accumulated depreciation is property, plant and equipment. Land is also property, plant and equipment. Common stock is stockholders' equity. Advertising is not applicable. This is for the income statement. And mortgage payable is the long-term liability. Okay. Now following are the major balance sheet classifications. Once again, we have to classify each of the following financial statements. So accounts payable is a current liability, accounts receivable is a current asset, accumulated depreciation is property, plant and equipment, building is also property, plant and equipment, cash is a current asset, interest payable is current liability, goodwill is intangible asset, income tax payable is a current liability, inventory is a current asset, then investment, it depends upon whether generally it is going to be a long-term investment. Then we have land, that is property, plant and equipment. Mortgage payable is long-term liability. Supplies is a current asset. Equipment is property, plant and equipment. And prepaid rent is a current asset. Okay. Let us move on to the next exercise. Classify each of the following financial statement items. So prepaid advertising is a current asset. Equipment is property, plant and equipment. Trademark is a intangible asset. Salaries and wages payable is a current liability. Income tax payable is current liability. Retained earning is stockholder equity. Accounts receivable is a current asset. Patents is a intangible asset. Bonds payable is long-term liability. Common stock is stockholder equity. Accumulated depreciation is property, plant and equipment. Unearned sales revenue is a current liability and inventory is a current asset. Okay. Let us move on to the next exercise. The following items were taken from December and we have to prepare the assets section of a classified balance sheet listing the current assets in order of their liquidity. So we start once again. We have cash and cash equivalent, that is 9215. Then we have the short-term investments. You see the word is short, it means it is a current asset, 2008. Then we have accounts receivable, and it is 5785. We have notes receivable, that is 368. Then we have inventories. You can see they are due before 31st December, so they are the current assets. Then we have inventories, and that is 16,933. Then we have other current assets, 966, and the total is 35,275. Then we look into the long-term investments, and for long-term we have only one, that because here it is due after December 31st, that is 5,460. You can just put it straight. 5,466. Then we have the property, plant and equipment, and that is 21,579. From this we subtract the accumulated depreciation of 12,795, that makes 8784. Then there is a intangible and other assets of 12,528, so that makes a total of 62,053. Okay, let us move on to the next exercise. These items are taken from the financial statement. We have to prepare a classified balance sheet. Assume that 13,600 of the notes payable, so where is here notes, we will keep an eye on this, will be paid in 2023. That means 13,600 is a current liability, while the balance will be the long-term liability. So we start once again. Since we are preparing a classified balance sheet, it has to be on the basis of liquidity. We start with cash, 11,840. Accounts receivable, 12,600. Prepaid insurance, 3,200. And the total is 27,640. Then we have land. Land is 61,200. And then we have building, and building is 105,800. From this we will subtract the accumulated depreciation on the building, 45,600, so that makes a balance of 60,200. And then we have equipment, and equipment is 82,400. From this again we will subtract the accumulated depreciation of 18,720, that makes 63,680. So the total is 212,720. Then we go for the current liabilities, and for this we have accounts payable, and accounts payable is 9,500. The current maturity of notes payable, that is 13,600. And then we have interest payable of 3,600, so the total is 26,700. To this we will add the long-term liability, and the balance, that is 93 minus 13,600 is equal to how much? 26,700. So the total liabilities are equal to, 93,600 minus 13,600, this will be equal to 80,000. So the total liabilities are 106,700. To this we will add the common stock, and the common stock is 60,000, and the retained earning. Now we have the retained earning, and let us see, we have the beginning retained earning of 40,000 and we do have to calculate the end. We don't have the ending retained earnings, so we will have the income, and income is revenue minus expense, and the revenue is 14,700. From this we are going to subtract the expenses, and the expenses are insurance expense of 780 and depreciation expense of 5,300, interest expense of 2,600, and what else? So we are going to subtract these expenses, and the result will give us the net income, revenue minus expense. And from this net income we will also subtract if there is any dividend. Let us see, accumulated, there is no dividend, so revenue, the beginning retained earning will be, to this we will add the net income, and that will be equal to 46,020. So once we add this up again, so this will be equal to 106,020, and this is equal to 212720, and this is just to verify that our assets are equal to the liabilities and stockholder equity. That means we have solved this exercise mathematically correct. Let us move on to the next exercise. The following items were taken from 2023 financial statement of Texas, and we have to prepare a classified balance sheet in good form as of December 31st. So once again we have the current assets, and we start with cash, and that is 1182. Then we have short-term investments of 1743. Then we have accounts receivable of 1823. Then we have inventory of 1202. Then we have prepaid rent of 164, and the total current assets are 6114. Then we have stock investment, as you can see, of how much? 600, long-term investment of 637. Then we have equipment props of 6705. From this we will subtract the accumulated depreciation of 3547. That will give us 3158. And then we have the patents of 2210. So the total is 12,119. Then to this we are going to record the current liabilities. We have accounts payable of 1459. Then we have income tax payable of 128. These are the two current liabilities. I think I can 1459, 128. And this is equal to 1587. Then we have the non-current liabilities, and the non-current liability is only 810. So the total liability, 810. So the total is 2397. To this we are going to add the common stock, and the common stock is 2826, and the ending retained earning uh, is 6896. So the total is 9722. So the total is once again 12,119, and we have done this exercise also mathematically correct. Let us move on to the next exercise. The following information is available for Ozone Incorporation, and we have to compute earning per share for the year 2023. And to calculate the earning per share, we have the earning per share is what is equal to the net income minus preferred dividend divided by the average common stock outstanding. So we first of all calculate for the year 2023, and for 2023 the net income is given as 100,000. From this we will subtract the preferred dividend of 10,000, and we will divide this by the average stock outstanding and beginning and ending, that is 120,000 plus 60,000 divided by 2, and this is equal to how much? This will be equal to 1.00. Now for the year 2022, the net income is 50,000 minus the preferred stock dividend, that is 10,000, and once again the average stock outstanding, that is 40,000 plus 60,000 divided by 2. So this is equal to how much? This will be equal to 0.8. Comment on the difference in the ratio of the, okay, and then we have to calculate anything else. Ozone primary competitor has earning per share of 2 in 2023. Comment on the difference in the ratios of the two companies. So we can see that Ozone's profitability, as measured by the amount of income available to each share of common stock, has increased from 0.8 to 1. So also if we calculate the average, it will be 1 minus 0.8 divided by how much? Divided by 0.8 again, and that is equal to 25%. So it has increased by 25% during 2023. Earning per share so should not be compared across companies, because the number of shares issued by companies, they vary very widely. So thus we cannot conclude that Frost Corporation is more profitable than Ozone based on its high earning per share. We have to look into other ratios as well before we make a comment about it. Okay. Okay. Now compute the current ratio and debt to total assets ratio for each year and comment on the changes. So the current ratio, okay, so that is current assets divided by current liabilities. Current ratio for the year 2023 will be current assets 88,000 divided by current liabilities 40,000. So this is equal to 2.2. for the year 2022, the current assets are 60,800 divided by 38,000, that is equal to 1.6. So these are the two ratios, and obviously you can see that the current ratio has improved, and debt to total assets. So let us calculate the debt to total assets also. Debt to total assets ratio. Now when we calculate the debt to total assets ratio, it is total debts divided by the total assets, and the total debt is let us start with 2023. So total debt is 120,000 divided by the total assets 400,000. So this is equal to, if you calculate in terms of percentage, this is going to be equal to 30% in the year 2023, and for 2022 this will be the how much we have the total debt as 150,000 divided by the total assets 341,000 into 100. So that will give us 43 point, almost 44%. So we can see that the companies, so we have calculated the current ratio and we have calculated the debt to total asset ratio and comment on the changes. So the company's liquidity as measured by the current ratio has improved from 1.6 to 2.2, while its solvency has also improved as measured by the debt to assets ratio, because here the ratio has declined, and obviously that is a good sign, from 44% to 30%. Okay. Compute free cash flow for each year and comment on the changes. Okay. So the free cash flow is cash provided by operations minus capital expenditure minus cash dividend. Now for the year 2023, cash provided by operations is 110,000. From this we are going to subtract the capital expenditure, and expenditure was 45,000. And we will also subtract the cash dividend, and the dividend is 5,000. So this is equal to 50,000. 50 is equal to 110 minus 45 minus, oh there is one more, 5,000 and 10,000. $5,000 and 10,000. So that makes 15. So this is equal to 50,000. Then we go for 2022. For 2022 we have the cash provided by the operation again, and cash provided by the operation is 70,000. From this we are going to subtract the capital expenditure, and the capital expenditure was 20,000, and we will also subtract the dividend, that is 12,500. So this will be equal to 37,500. So we can see that the amount of cash generated by the company above its needs for dividends and capital expenditure, again it has increased from 37,000 to 50,000, and that is a good sign as such. Let us move on to the next exercise. The following information is available for Gerard Corporation. Compute earning per share. We have to calculate the earning per share for 2023 and 2022. And the change, and the primary competitor Thorpe Corporation had earning per share of 1 in 2023. Comment on the difference in the ratios. Okay, so when we have earning per share, so we have the net income, the I can put it again, earning per share is equal to net income minus preference dividend, not common, only preference, divided by the average common stock outstanding. So we have a net income. We start with 2023. So for 2023, the net income is 80,000, and the preference dividend was 6,000, divided by the stock outstanding, that is 75 plus 45, divided by 2, and this will be equal to 1.29. For 2022, we have the net income of 40, and the preference dividend is 6,000, divided by the outstanding, that is 40,000 plus 30,000, divided by 2, and this is equal to 0.97. So you can see that the profitability as measured by the amount of income available for each share of common stock has increased from 0.97 to 1.29. So if we calculate in terms of percentage, it will be 1.29 minus 0.97 divided by 0.97, and that is equal to 32.48%. So earning per share should not be compared across companies, as I have already told you before, because the number of shares issued by companies, they vary widely. Thus, we cannot conclude that Thorpe Corporation is more profitable than Gerard based on its higher earning per share. Then we go to the second one, and let me clean up. Compute the current ratio, and current ratio is current assets divided by current liabilities. For each, and comment on, we have to compute the current ratio and debt to total asset ratio. So current ratio, that is current assets upon current liabilities, and for 2023 current assets are 54,000 divided by the current liabilities, and this is 22,000. So this is equal to 2.45, and for 2022 this is going to be 36,000 current assets divided by current liabilities 30,000, that is equal to 1.2. So and then we look into the debt to total assets. So the total liabilities, are, if we start with 2023, total liabilities are 72,000 divided by the total assets, that is 240,000. So this is equal to, and times 100, because this is in percentage, so that is 30%. For 2022, the total liabilities are 100,000 divided by the total assets, that is 205,000 times 100, that gives us 48.78%. So we can see that the company's liquidity as measured by the current ratio, they have improved from 1.2 to 2.45, and its solvency, you can see, has also improved as measured by the debt to total assets ratio, as it has declined from 48 to 30%. Okay, we move on to number C. Compute free cash flow for each year and comment on the changes. So free cash flow is what? Free cash flow is free cash flow is cash provided by operation minus capital expenditure minus cash dividends. So cash provided by operation is for 2023 is 90,000 minus capital expenditure of 27,000 and minus the dividend paid, that is 6 plus 3, that is 9,000. So this is equal to 54,000. For 2022 it will be 56,000 cash provided, 56 minus expenditure on property and plant, that is capital expenditure 12,000, and minus the dividend paid, that is 7,500. So this is equal to 36,500. So the amount of cash generated by the company above its net needs for dividends and capital expenditure, they have increased from 36,000 to 54,000. Let us move on to the next exercise. The following information is available. There were these many number of shares outstanding. So what was the company's earning per share each year? So earning per share, once again, earning per share is equal to net income minus preference dividend only, not common dividend, divided by the average common stock outstanding. So we start with 2023, and for 2023 the net income was 66176. There is no preference dividend, that is 0, and the shares outstanding at the end of the year is 64. So it is at the end of the year and this is at the end of the year, so we will make an average of these two, and that will be equal to 65,394,500. So this will be equal to 1.012. For 2022 it will be the net income 54,587. The preference dividend is 0 divided by average, and for this we will add 73 plus 66,282. So and divide by 2, this will be 69,710,500. So this is equal to 0.783. So what was base of or earning per share? This was the earning per share 1.02012 and 0.783. Now based on your findings above, how did the company's profitability change from 2022 to 2023? So using the net income or loss as a basis to evaluate the profitability, you can see that the profitability of 2023 was 66,176,000, and for 2022 it was 54,587,000. So definitely the profitability has increased, and if we want to calculate in terms of percentage, we have to divide it by 54,587, and that is going to equal to 21.23. So the profitability has improved by 21 29 by 21.23%. And what else? We go to number C. Suppose the company has paid dividend on preferred stock. I would simply remind you to please verify this number. I have doubts if I have calculated correctly. Okay. Then suppose the company had paid dividends on preferred stock and on common stock during the year. How would this affect your calculation in part A? So to determine the earning per share, dividends on preferred stock, obviously you know that it has to be subtracted from the net income, but dividend on common stock are not subtracted. Just keep this thing in mind. Okay, let us move on to the next exercise. Nordstrom operates department stores in numerous states. Selected financial statement is available here. Calculate the current ratio and the working capital based on the preliminary balance sheet. So we have at the beginning of the year and at the end of the year. We start with A. So working capital at the beginning of the year will be how much? That is current assets, and the current assets will be cash, receivables, merchandise inventory, other. So we have the total current assets of 3,361 minus current liabilities, and that is 1,635. So this is equal to 1,726. Then the current ratio will be current assets 3,361 divided by 1,635, and that is equal to 2.06. Okay. Now then at the working capital at the end of the this was for the beginning, and we are now going to go for the end. So once again at the end we have the current assets 3,217 minus current liabilities 1,601. So this is equal to 1,616, and then the current ratio will be 3,217 divided by 1,601, that is equal to 2.01. We move on to number B. Based on the results in A, the CFO requests that 20,000 of cash be used to pay off the balance of the accounts payable account on December 31st. Calculate the new current ratio and working capital after the company takes this action. So for this again we are going to prepare the current ratio. So we have I'm sorry, actually this part is for the next exercise, so just ignore this for this section. So we can see, let us look into and based on calculate the current ratio and working capital based on the preliminary balance sheet. So if you look over here, that the liquidity This was at the beginning of the year, and this is at the end of the year, so the liquidity has decreased, and even that's why you can see that the current ratio has also decreased in this exercise. I'm sorry, I mean this is a part of the next question exercise that we are going to do, so just ignore this section. Let us move on to the next exercise. The chief financial officer of Padilla Corporation requested that the accounting department prepare a preliminary balance sheet so that the CFO could get an idea of how the company stood. He knows that certain debt agreements with its creditors require the company to maintain a current ratio of at least 2:1. Okay, so we have to calculate the current ratio and working capital ratio based on the preliminary balance sheet. So we are going to prepare the current ratio, and that is current assets divided by current liabilities, 60,000 divided by 30,000, that is equal to 2, and the working capital will be 60 minus 30, 60,000 minus 30,000, that is equal to 30,000. Now, based on the results in A, the CFO requests that 20,000 of cash be used to pay off the balance of the accounts payable account. Calculate the new current ratio. So if we are going to pay 20,000, so our cash is going to decrease by 20,000 and our liability will also decrease by 20,000. So our new current ratio will be current assets, that is 40,000, divided by current liabilities. Now that is going to be 10,000 because they are going to decrease by 20,000. So this is equal to 4, while working capital will be 40,000 because our cash is going to decrease by 20. So 40,000 minus 10,000, that is equal to 30,000. Okay. Now discuss the pros and cons of the current ratio and working capital as a measure of liquidity. Now liquidity, it shows if a company can pay its bill on time or not. Having more cash and assets than immediate debts usually means it can meet obligations promptly. Working capital and the current ratio compare assets to debts, indicating liquidity. But just having enough assets doesn't guarantee smooth payments. If most assets are in cash, like inventory or prepaid expenses, the company might struggle to pay bills even with good working capital and current ratio. For instance, the company might only have 5,000 in cash after paying a 20,000 bill, leaving little for 10,000 in salaries. This might force the company to borrow money to pay salaries, and this will increase the cost and even decrease the profits. Was it unethical for the CFO to take these steps? Now, using 20,000 of cash to settle accounts payable isn't inherently unethical, but if it is done solely to boost the year-end current ratio and mislead the creditors, that could be seen as unethical. You can see that the current ratio increases to 4 from 2. So asking for a preliminary balance sheet before making the payment might suggest manipulating the company's financial status, which is generally seen as unethical. Let us move on to the next exercise. We have to calculate the debt to total assets ratio, and we have to calculate free cash flow and look into it. So first of all, once again, we have the debt part A, debt to total assets ratio, and we start first of all with 2023. So for the total debts are 554,645, and the total assets are 1,963,676. So times 100, this is equal to 28.25%. And for 2022, the total debt is 55 to 7,216 divided by 1,867,680 times 100, and that is equal to 28.23%. So calculate the debt to total assets ratio and calculate the free cash flow. And for once again, for free cash flow, we know that it is we start with 2023 cash provided by operations, and cash provided by operation is how much? 302,193 minus the capital expenditure, that is 265,335, and minus the cash dividend, that is 82,394. So this is equal to the answer is negative. Is negative 45,536. This is for 2023, and let us see what happens in 2022. Now in 2022, the cash provided by operating activities is 464,270 minus capital expenditure of 250,407 minus 8796, and this is equal to 133,067. So that is how we calculate the free cash flow. And then they ask us to discuss the solvency in 2023 versus 2022. So when using the debt to assets ratio and free cash flow to assess solvency, American Eagle showed worsening performance. You can see, although its debt to assets ratio stayed the same, almost the same, 28.25 and 28.23. But its free cash flow, it has dropped drastically from 133 to 45. So if we calculate the in terms of percentage, it is negative 45,536 divided by 133,067, almost 134%. It has decreased by 134%. So it is obviously a notable decline in solvency. Then discuss American Eagle's ability to finance its investment activities with cash provided by operating activities and how any deficiencies would be met. Now in 2022, American Eagle made more cash from its operations. They have made more cash from its operations than it is spent on investments. You can see over here, ensuring it had enough to cover its needs. However, in 2023, it faced negative cash flow. I have already shown you here. There is a negative cash flow, meaning it didn't generate enough cash to cover its expenses. And this shortfall could have been resolved by raising money through selling stock or taking on some debt. So this completes the second video on a further look at financial statements. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.